welcome to another episode of The Future Current. I'm your host, Sean Swentek. Today, I'm joined by Tariq Nanji, partner and associate director at Boston Consulting Group. Tariq, thank you so much for joining me today.
Thanks for having me, Sean.
Real honor to have you on the show. Excited to get into this. We've been talking for a while about this episode, and I think the listeners are in for a really great episode today. I was digging in, doing some research as I will, and I found a recent BCG study that was talking about that first mover advantage. And they really noted how first movers on climate found that the cost of action was 5 times less than the cost of inaction as it pertains to climate investments. For those developers, asset managers, investors listening today, how do you quantify that inaction tax in a way that actually moves decision makers to take action?
Yeah, it's a great question. I think you kind of have to move from the abstract to the tangible for most folks. So this is if you talk about climate risk as this sort of abstract notion, it becomes harder to materialize and think about how that impacts your actual investment decision making. And the way you do that is you start to think about translating climate risk into metrics like that impact valuation. So that go directly into your cash flow, that go into your cost of capital, and ultimately impact your IRR, your rate of return for a given investment or project or whatever it may be. And some ways to think about this, I think, can be, one, maybe integrating it into a cash flow line item effectively. So thinking about the fact that it could be increasing ongoing costs for a given project or program. You might have higher insurance premiums associated with a certain project based on location. You might have higher O&M expenditure as a function of climate risk. You might have more outage potential. So all of these things can ultimately impact the cost line item and translate into directly to cash flow impacts or rate of return impacts. Another way to think about it maybe is climate exposure widens the risk of a given business or an asset. And so if your risk of that asset is higher, even by, changing a cap rate or a return threshold by 50 basis points, you can translate that risk into a spread on return on the outside, on the tail end of it. And that's even without in a renewable context, without even getting rid of a single kilowatt hour of production. So if you can translate the physical risk, climate risk, whatever you want to put under the umbrella of that into a valuation impact, that's where you start to see, boards looking at it. You start to see companies assess it in a certain way, and it becomes part of the ultimate underwrite of a given asset.
It's great to see this entire idea of ESG being really sort of ephemeral and like an idea to there's real data that shows the real return and value that this contributes to the asset. So it's exciting to see that transition. We've talked on the show, I have with guests, about how renewable integration affects property valuations. From your seat at BCG, are you seeing a widening valuation gap between brown assets and green assets? And is that gap driven by actual cash flow or, like I was just saying, ESG sentiment?
Yeah, it's interesting. I mean, if you asked this question 5 years ago, you'd probably say sustainability and ESG is the driver for all of these changes. I think what's happening now is that there's a bit of a shift happening from how folks think about sustainability, and it's less the idea of sustainability and more how does that translate into underwritten cash flow metrics for a given program or project. So it's about taking the theoretical and putting it into practical terms, and what does that mean for my underlying economics of a project. So when you take this into the context of brown to green or brown assets versus green assets, the example I like is if you think about real estate as an example. If you took a set of properties or real estate where the energy ratings are much better than others, all else equal, folks tend to price in a premium for those types of homes. And why? Well, it's because you're baking in lower energy bills, you're baking in retrofit changes being less frequent, you're baking in various factors that impact your cost structure for that house or that home, and that impacts value, right? So when you think about brown to green in an infrastructure context, you can kind of think about it, at least I tend to think about it in similar ways. Like one is maybe you have higher discount rates for for certain sectors versus others. Maybe you have more conservative, debt metrics that you apply to a given asset. And the one, the very clear, tangible one in my mind here would be like, take coal versus renewables as like a prime example, right? Like coal now faces higher financing spreads, has a harder time of refinancing. You tend to think about shorter asset lives. Like these are all risks that get baked into that versus a solar or wind project, which has typically had lower cost debt, is higher leverage, is attracting capital from third parties like pensions and infra funds and so on. And that effectively shows you the delta in the brown to green spread, so to speak, and how you think about, where that's getting priced in. Now, is that a sustainability thing or is that a cash flow thing? I mean, you can argue it's both, and you can argue you're having both impacts, but I think what we'll see is the decision metric that's used from an investor point of view, or from from someone trying to allocate capital to projects, is it's starting with the cash flow side and then saying, okay, well, do I also have a sustainability impact as part of this?
Great points. And as incentives start to fade out in the U.S., at least around solar, I think there was this consensus that that could be a huge blocker to investment dollars coming in. But I think we're not seeing that. At least I'm not seeing that in the market. It seems like every news announcement I see is that the numbers make sense, to the point that investors are not shying away from renewable investments in the U.S. today. In fact, they're almost accelerating in a lot of areas.
I mean, what's fortunate is I think everyone's now seeing that the cost of renewables or solar is at parity or better than sort of conventional generation, right? So that just paints the picture of like the economic argument is there for it to be persistent, and hopefully that will continue, as we get more scale and costs continue to come down.
Yeah. And as you mentioned, you throw in the rising energy costs, and the conversation just changes again immensely. When you're conducting due diligence on a solar asset or a storage deal asset for an institutional investor, are there any red flags that you're looking out for that you would signal to them, hey, you might want to walk away from this deal. It's probably not the right investment for you.
Yeah, I mean, look, we would typically think about some of the traditional elements of, if you take a traditional diligence, you're going to always look at some of the broader market attractiveness factors of a given project. So, like, are the power markets fundamentals good? Is the policy environment supportive in that state, region, locality? Ultimately, like the question of like, is that where you're situated structurally supportive of renewables in the long term? I mean, if
Mm.
you can pick that box, okay, great. Then there's the question of like, I think where the challenges tend to occur is more on your offtake that you're securing for the project, the execution of the ability to put those projects in place, and ultimately the quality of the pipeline of what you're trying to build out. And I think these are where things, we see tend to could fall apart, right? Like one is on the offtake side, like is the PPA you've secured, a good one or a weak one? Like how do you think about the nature of the PPA structure? How do you think about the counterparty that's actually like dealing with who's off taking that energy from you? And is the quality of the counterparty a good quality counterparty?
Mhm.
On the pipeline side, you then get into this question of interconnection, feasibility, and realism. I think is always like a question here, which is, are you baking into this developer all of their future projects or some probability weighted version of those future projects? And how grounded is that in the current dynamic around interconnection timeliness, which is, as a massive challenge. And that's where things can fall apart a little bit, is like, what are you actually accounting for in that, and how real is that pipeline? On the execution side, this boils down to ultimately like, who are your EPCs? What kind of procurement are you using? Like, what is the risk around actually getting, once you're good to go, can you get it in the ground fast enough and get it built
Mhm.
fast enough? And that execution risk ultimately boils down to the parties you're using. What kind of risk is there with their history with you as a developer? Is there like a credible way that these things will get into the ground? And that's again an area where it falls apart. So I think when you do a diligence on one of these types of businesses, of course you're going to look at all the market metrics, but once that passes the sniff test, then it becomes all about like operational execution, certainty of your customer base, and like the real sort of nuts and bolts of getting this stuff moving, which is where the challenges tend to occur or not if you're a large, more, developer is able to solve those challenges.
For those watching this recording on one of our video channels, they probably saw me smile when you said interconnection. I always have a game in my head of how long into the interview before that word comes up as the topic. And I can't wait for the day when we solve for that in the US because it's just an eternal frustration. Many of your clients are large private equity firms. These folks have been, many of them dipping their toe into renewable energy for some time now. Some are starting to move to true gigawatt scaled portfolios. What is the operational blind spot that you're always making sure you point out to these folks that could eat into their returns as they start to get more exposure to this market?
Yeah, it's a great question, and you're not gonna like the answer because I'm gonna go back to interconnection realism as a part of uh but I think, there is always a question of like when you're scaling megawatts faster than what you can actually get done. This again goes back to a little bit of what we were just talking about regarding operational feasibility of getting these
Mhm.
projects going. And at gigawatt scale, I think if you think about what can eat returns, like clearly one of them is, if you're assuming best case Q outcomes for the interconnection, you're probably underwriting a portfolio of projects that is not realistically going to all materialize
Yep.
given what's going on. And so if you're if you're not accounting for that effectively or not probability weighting those programs, I mean, that's where you get into some real challenges where the promise of what you're underwriting is not what will ultimately come out in the end as part of the portfolio. The second I think is a little bit touches on what we talked about, but it comes around like standardizing performance and operations of the business once you have it. And so what do I mean by that? It's like that if you have a lot of assets in your portfolio at that type of scale, the question will come down to, who has bought the best panels for putting those solar programs in the ground? Who has thought about detecting issues faster? Who has thought about being able to manage like insurance or warranty claims? Like
Mhm.
who's thought about managing your curtailment risk and who's thought about, dispatch across your suite of assets in the right way and getting the operational side down is what tends to then drive some of that spread. There's a study that folks in our firm had done around what is the spread on like top quartile developers versus the rest. And what you kind of find is like if you're a top quartile developer, you ultimately can spend something like 16 to 30% less per megawatt on renewables from managing the asset better. And that is I think, direct attribute, like directly hits your return profile as an investor, directly hits your ability to scale these assets in a way manageable. And so I think if you put those two things together, if you can manage the interconnection side well and think about that well, but also deal with the operations and cost and manage that, I think, you can be set up for success, barring everything else also.
The many, many other factors. I mentioned earlier the capital continues to flow in, especially for energy production and sort of climate mitigation, if you will, solar, wind. But I know you've written a lot about the ideas of adaptation and resilience, protecting infrastructure and real estate from climate change. For a solar developer or an real estate asset owner, an infrastructure investor, does the future of bankability depend more on the energy they produce or how well that site could survive a 100-year storm?
Yeah, I love this question because I think nowadays you can't decouple those two things.
Mhm.
It is again, like if you look 4, 5, 6 years ago, I think it was all about yields, quality of the production, generation, get what you can, produce it, get it out there. That was the motto. I think now it's not only about that, but it's about adaptation and resilience being a gating factor to future production. And
Mm.
what lenders and investors are looking at sometimes is, you know, they're seeing things like what's happened in ERCOT with some of the hailstorms that have happened there, or, around solar farms, or what's happened in California or Florida when you think about flood risk and all of this, and what does that mean, and wildfire risk also at the same time. And what they're looking at is then saying, okay, well, if I'm gonna lend to this developer or invest in this developer, how do I think about things like, well, are they putting in the stuff that helps the, panels move in the right way so that they can stow? Or are they putting in the right solutions to ensure that the trigger points for when that happens is done effectively? Are they managing their insurance effectively? Because now that's like a real question and a cost,
Mhm.
you know? And so all of that has a view towards, well, are they going to be the most resilient business in the long term, should something happen, and do they have all the right puts and takes in place? So it is about energy yield, energy production, certainly, but it's also about like managing the risk associated with some of these assets. Now, if you're not, but located in Florida or California, some of these areas that are more prone to physical risk or climate risk, there is still an element of like, well, it could happen. I mean, if you took wildfire as an example, and you looked at you know, Canada last year, like pretty much you turn the corner in the whole country. You could look at one of those heat maps. We had the most wildfires we probably had in a long time, and it's scary, right? So folks see this and are trying to make sure that the things we're investing in are protected against some of these challenges in the long run.
It's a great call out, and I can put a real world example on that real quick too. I don't know if you recall, a couple months ago in California, there was this huge fog bank that like sort of swept Central California for a period of time. And we had clients who were saying, "What is going on with this super low production in our assets in the Central Valley of California?" And being able to sort of look into the future of how long that's going to be there and the impact on the return and the production is so important to understand and model into your expected IRR on that asset. So again, it doesn't have to even be a 100-year storm. It's like the climate, changes are so immense that we're seeing things just like fog for a month long that we wouldn't have probably seen very often in
Yeah.
previous times. But you've got a background in electrical engineering, software, and many other amazing things. AI is a personal passion thing for me as well as many others in the world today. And we hear a lot about sort of AI for everything. Specific though to climate investing, where is AI actually like moving the needle? Is it, in predictive maintenance for renewable assets and storage, or is it in underwriting, risk modeling? Where do you see this as really having the biggest opportunity?
Yeah, I mean, this is also a great question. I mean, the AI question is fundamental to everything now. I think you have to think about it in as kind of impacting everywhere at the moment, and if you take it from the lens of the businesses themselves or the developers themselves or the climate related assets themselves, there's a whole host of AI related tools that are now getting put to the forefront or getting tested, and they touch things like, I mean, you mentioned like things like sensing and measurement, or in some cases digital representation, like digital twinning is a whole thing, and how do you manage that, and prediction and maintenance and planning and optimization and control, and market coordination as you think about things like ancillary markets and so on, and things of this nature, right? And how do you help companies use AI as a tool to help them be more effective? That is like a real thing and is getting, in many places, getting tested, right? Now, when you think about the investment process around this and like how does an investor look at a business and then incorporate AI into their workflows, this is where it's kind of early days, but is getting tested in many ways, and you start to see things like, can you use AI as a way to help underwrite or help accelerate the underwriting of like contract review, or help accelerate your understanding of interconnection risk and triage that risk across a portfolio of assets, or can you assess your climate risk and stress tests for a given business using AI tools, and all of that with the lens of like getting more certainty in an uncertain world around what you're investing in, because there's only more volatility, not less. And I think these tools are trying to be utilized both by the investor side to improve their decision making around investments, but also the companies themselves to improve operations, make things more efficient, and run their businesses better. And this is a bit the tricky part of, if you're like, the ask of sort of where is it more salient is, like, we don't know. I mean, it's being tested and trialed and utilized kind of in real time, and so time will tell what sticks, but I think, as you look at every forecast around AI and data center growth, it's up and to the right. So I guess we'll see.
I love what you said there, levering AI to drive certainty in an uncertain world. That really resonates with me. I'll ask you to be a little controversial for a moment here. Is there a common investment thesis in the clean energy market that maybe is widely believed, but you think there is either fundamentally wrong or you've got some issues with?
So what I would say to this is, there is a common metric that you always see many sponsors use or investors use, or even project developers use as they think about where they want to put their next asset. And it comes, everything tends to always boil down to LCOE and energy decisions. And I think LCOE is certainly a very useful metric, but it's not like the be all end all of an investment thesis. And in reality, like, I mean, you know this, Sean, like a megawatt hour at 2 p.m. is not the same thing as one at 8 p.m.
Yep.
Or things like congestion, tape, curtailment, capture, all these things like impact how you think about your overall economic profile. And so the right thesis in my mind isn't always just like what's the lowest LCOE, because that I mean that is the thing to check, but is not the be all end all. Like the right thing is like, are you getting the best risk adjusted like value per unit of megawatt that you're developing? So it's like taking the risk metric as a more holistic measure than just simply using LCOE as a basis to make decisions. Should that inform things? For sure, it should help inform investment decision making. But is it everything? Not always. And that's where I struggle sometimes with how some of these decisions get made. But you know, that'd be the place to probe on.
100% agree. Do you think battery storage and other means of storage is going to have a meaningful impact on that LCO conversation?
I think so. I mean, like the reality is there is only more of a need for firm power. There's only more of a need for balancing load. And when you start adding storage to the mix, it certainly changes the economics and changes how you think about when you can dispatch power, charge and discharge and use different timing points in the right way. So it certainly can be, I think it's going to be a great tool for things on a go forward basis. And we'll see. I mean, you're starting to see a lot more solar and storage come together now. So that's really that's going to be the test, I suppose, as we get into it.
Yeah, we're getting to see it play out in real time. There's a lot of talk in the market about interest rates, and they've been rising for some time, and they're sort of flat right now. But how are those rising interest rates and cost of capital? How's that reshaped which types of renewable energy projects actually pencil today for institutional investors?
Yeah, it's interesting. I mean, even if you took the market more broadly, like the climate and sort of the energy transition market more broadly, the 5 years ago, IRA came in. There was all this sort of like, I use it climate euphoria. There was all this like, let's put a bunch of money to work in the space, which was exciting, obviously. And I think at the same time, you had a low interest rate environment on top of it all, so that only helped accelerate projects getting put in place. And what's happened is like the reality is that was a sort of a grow at any cost sort of environment to now like grow in the right way and scale in the right
Yeah.
way to the environment. And I'd seen a report that said something like 2% a 2% increase in the risk-free rate can actually increase LCOE materially for renewables. And what that means is like those who are putting in place the effective measures to be a true platform that is managing their costs effectively. You're not at the tail end of the project portfolio, but you're actually like an effective developer putting the right tools in place, managing your operations clearly. Like those will continue to succeed. And it's now again coming back to the argument around, are you economically viable versus are you just there to generate yield for power, right? Which is the challenge, and you're seeing some of that play out right now, actually in real time in the market. So
We brought up data centers briefly earlier, but data centers account now for about 25% of operational costs and energy. As AI drives data center demand through the roof, which is what we're seeing, how is BCG advising clients to balance that massive energy thirst of AI with net zero commitments?
yeah, this is a great question. This is like it's like the collision of two big forces, right? It's like this AI wave and this energy transition thing trying to hit each other at the same time. So there's no AI without electricity. I think that's like clear, and you're seeing that in all the load growth projections. Both that we put out there, but other third parties, you're seeing pretty similar up to the right projections on load. I think the question also comes to, well, how do you think about the build out pace for these data centers? How do you think about the build out that's going to occur in and around this, and what does that then mean for all of the enabling services around this, and how do they keep up? How do supply chains keep up? There's a whole host of questions that come to how fast this AI thing will materialize. Now, for companies trying to think about keeping their like decarbonizing and keeping their energy transition commitments in place. This is where things like how do you use efficiency as a tool to help sort of decarbonize your businesses? Like, take a data center, like, can you use better cooling solutions? Can you have better utilization of your hardware? Can you load manage more effectively? Can you scale it in an effective way? These are all things that can help those companies like think through the lowest emission intensive way to scale their power generation. Now, the challenge also comes with like the amount of power that's needed to do a lot of this is pretty wild. And so how do you ensure the generation sources you're getting are cleaner where you can make them cleaner? And that is a tricky question because there's a little bit of a, you know, take what you can get right now versus try to get the cleanest. And that's where the challenge I think ultimately sits, is like, can you get enough clean generation sources out there to help scale this stuff in a clean way?
Fingers crossed, that's for sure. And now you've also helped clients establish brand new climate funds from scratch. Is there a common structural or strategic mistake you see in these fund formations?
Yeah, I mean, look, like when you think about putting a vehicle together to support investing in a theme like this, the most common sort of challenge I think is like you have a thesis, you have a place you want to hunt. The question is, can you go and ultimately execute against it and do it in a way that brings differentiation to the market? And so more and more nowadays, you know, if you were an infrastructure investor, the question wasn't, you could reap a nice coupon from a long-term contracted arrangement and so on. But now, things are evolving and you're seeing teams deal with sales forces. You're seeing a whole host of things where you need to support these infrastructure businesses on scaling and growing. And that's a model that, private equity has seen clearly in the past, but infrastructure is now, certainly dealing with. And I think if you can bring the right portfolio playbook or value creation thinking to investments that you own, that's where you can have an edge, and that's where you can start to think about how you support these energy transition businesses, because you're dealing with things like policy, you're dealing with things like new market entry, trying to scale a new technology, trying to find offtake, trying to get new customers, trying to do this in a cost efficient way, like we just said. And so these are all challenges that some of these companies face as you acquire them. And your value as an investor is of course money to some degree, but it's also like, how do you help them through the journey so that they can get the returns they want on the back end? And setting up those sort of partnerships, those capabilities is almost paramount nowadays.
Well said. What do you think is the single biggest misconception institutional investors have about climate investing that you find yourself having to repeatedly correct?
Yeah, I mean, we put out a publication on climate investing is not dead. It's just evolving. And I think so the misconception I think is, is the theme sort of fizzling away, or does climate investing effectively apply lower returns,
Yep.
by playing in this space? And what I say to this is like a couple things. I think one is, this is not a niche investment theme. Like, this is a very durable, underwritable growth trend globally, and is not only driving returns, but drives real impact on the world. And you're seeing that because well over 50% of mitigation solutions are in the money today, and that's like a function of cost curves having come down. So there is like very real, direct economic impact that has happened that can drive positive returns for investors looking in this space. The second thing I'd say is like, these thematics evolve. Like what it means to invest in energy transition, to our AI conversation, is an evolution of how you think about this. And what that does is it creates new themes, like things looking at baseload power as a key thematic, or looking at nearshoring of production, or looking at how you bring the enabling services to the digital AI ecosystem, or how you think about transmission and grid needs, because that's a real challenge right now as you think about the power demand that's going to be required, and how you think about adaptation and resilience. So these are all like thematically tied to climate, energy transition, climate investing. These are all tied to areas where you can generate real returns. And there are ways to play in this space if you are a climate investor, whether it's infrastructure, private equity, or growth equity. So the point isn't is like is every deal in the energy transition space a good deal? The point is like you can find stuff that meets your risk return, and you can find stuff that also meets your impact goals, and those two things can be found in the market if you look for it.
When you advise on integrating sustainability into fund strategy and operations, what does that truly mean beyond just checking the ESG box?
Yeah, it's funny. Like when you think about the investment life cycle, I think it varies from step to step, right? So when you think about sourcing as an investor, if you're applying sort of the right metrics as it pertains to identifying companies you want to look for, are you putting the right screening tools in place to isolate those that have the right sustainability profile that you're looking for? That is an important thing versus saying I own companies only and they tick a certain set of boxes that say they are sustainability aligned. The second thing would be in diligence. You're looking to buy a business. Are you integrating climate risk assessments into your diligence process? Are you looking at pricing in things like all the things we talked about, like permitting risk, counterparty risk, the effective sort of flood risk or climate risk associated with where you're located into what you're doing? Like that is a pretty critical element of how to think about integrating sustainability into the investment life cycle. I think another area you think about is, like, of course, on ownership. When you own a business, are you helping your companies manage some of this risk and giving them the tools they need to actually deliver on some of these sustainability goals versus leave them to do it themselves and figure it out, by the way, in addition to their day job of trying to deliver on energy production or other things, right? So there is more than just the like, are you reporting the right metrics back to the sponsor? It's can you help them deliver on their goals? Can you identify the companies in the right way? You're incorporating some of this thinking into your diligence process. All of this together is truly how you integrate sustainability into investment decision making.
Well said. Well said. How does data and analytics play a role in creating value post acquisition when your clients own renewable energy assets?
Yeah, I mean, look, the data analytics kind of it's everywhere in every facet of what everyone is doing nowadays.
Mm.
And I think if you take it from the lens of like a developer, I think you can use data analytics to do a couple of things very simply. Like, can you generate more megawatt hours? Is, can you use data analytics to do that? Can you use it to generate more dollar per megawatt hour that you generate? And the reality is like there's a lot of tools out there that can be used to, you know, optimize your fleet or optimize your portfolio of assets. There's a lot of tools out there like, we talked about predictive maintenance as an example that can reduce downtime and help produce more. And so often the the use of data and analytics to drive more generation or more dollar per unit generation is where these tools are getting utilized, and I think ultimately is how they should be getting utilized to drive higher, ROI on the business.
Specific to how you would advise a renewable energy portfolio investor or a independent power producer, what's your advice around exit strategies in today's market versus 3 to 5 years ago?
So there's a few things. I mean, if you think about the nature of the world 5 years ago, it was all like build something, get a PPA signed, flip it, and like you could do that. And that
Yeah.
was a very easy thing to do. Now it's like, hey, there's a lot of risk in the market on a go forward basis. And so how do you give conviction at exit that some of these risks are mitigated or managed by the developer? And that's things like, can you give contracted cash flow certainty for, the next X number of years based on your pipeline? Can you give conviction that you can get a, shorter time to COD or improve your ability to get interconnection, put in place? Can you deliver these things in a way that gives conviction and comfort to the buying party that what they're getting is what they're getting, right? Which is a machine that can work versus a thing that you're hinging on effectively just like a growth market to spur the next sale. And most buyers when they look at these things, they're not just thinking about their hold period, they're thinking about the next hold period.
Mm.
And And is, can you give that level of conviction on some of these things, which is where things have kind of evolved, and how to think about an exit. So those would be the pieces, I think, if you think about an exit today versus an exit 5 years ago, it's, can you provide those mechanisms to give comfort and conviction to the buyer?
5 years from now, what will matter more for institutional investors in renewables? Having the right technology partners, the right regulatory strategy, or is it simply the right operational playbook?
So look, I think again, this is gonna be a terrible answer, which is all of the above. But there is I think a rank ordering in my mind of how I think about this. We've talked a lot about like the nature of having efficient portfolios or having those that run at a low cost or can manage their operations effectively. I think that operational playbook is certainly a critical element to getting things right on a go forward basis. So if you can manage the price you capture in an effective way, if you can, protect your cash flow, if you can do things that will help the operational side to ensure those things are in place, that is I think now more than ever, an important element to how you would think about some of this. That said, like, look, regulation still matters. It is especially in markets where you have like transmission reforms happening, or you have changing rules for how portfolios you need to manage that stuff and do that effectively. But that's about like managing risk, right? It's about risk mitigation in some ways versus like using your operational playbook to drive upside in the business, which is why I have this like rank ordering in my head of those two things. Technology also at the same time, it can be an important lever to extract. We talked about AI and these tools, like it is an important lever to get value out the door in many ways. But it has to fit like the context of like what you are doing in your operation strategy. So it certainly ties to how you're managing your operational playbook. If you can link technology with the operational playbook, that is in itself a good recipe for, the business in the long run versus technology for the sake of technology.
Could not have said that better myself. Tariq, this was such a pleasure to have you on the show. If listeners want to connect with you or follow along with your work or what is going on at BCG around renewable energy, where's the best place for them to go?
Yeah, I mean, you can check out a lot of our thought pieces on our BCG perspectives sites, and we cover certainly all end markets, all climate technologies, and have a great view on how to think about this from the lens of both an investor and an operator. And folks can certainly feel free to reach out to myself or others within the firm as things evolve for them.
Wonderful. And the website, bcg.com, do I have that right?
Exactly.
Excellent. To all my listeners, thank you for tuning in to another episode of The Future Current. I'm your host, Sean, and I'll see you next time.